Good afternoon. So this session is on Allianz Technology Trust. We're joined by Walter Price and Mike Seidenberg from San Francisco, who right at the epicenter of the technology world. On holiday in California a few years ago, Mike arranged for me to visit the Facebook campus, which was a really quite extraordinary experience. And I'm not sure my wife was as interested as I was, but there you go. But it did emphasize to me how connected the Allianz team are able to be, close to the very undercurrents that shape this very rapidly evolving sector. Walter has been investing in technology companies for over 35 years, and the team took over management of the trust in 2007. When I think the share price was around £2, the shares broke the £30 barrier earlier this year. But on a NAV basis, the team have considerably outperformed over the years, showing a willingness to invest in both large and mega caps, but also mid caps. But before I hand over to the team, a tiny bit of housekeeping. We'll have 30 minutes of presentation, 15 minutes after that available for questions. Your microphones are muted, but if you ask questions using the Q&A button on the bottom right-hand side, I can put them to the managers for you. If there's too many questions for time, then we will try and get those questions answered and sent back to you after the event. So without further ado, here is Walt and Mike.
Thanks very much, Willie. So this is just a slide that shows our considerable technology team in San Francisco. Karen Hyatt is the head of the group, and you can see our group as well as a group that runs our AI fund, which is a $10 billion fund that's offered in all parts of the world. And each of us has an area of specialty. This is the group that runs your technology trust. Mike and I are the lead portfolio managers on this fund, and we all have different backgrounds, and we've been working together for over 10 years. I'm very focused on new ideas and also doing some marketing for the fund. Wachan is the person that looks at the strategy and the valuation of different sectors of technology, the performance, and looks at areas that are improving or coming under pressure. So he helps optimize our ideas. Danny is a Mandarin speaker who grew up in Taiwan and is very close to the companies in Asia, as well as the supply chain and the hardware companies. So that's what he follows for us. And I'll let Mike introduce himself and talk a little bit about his background.
Sure, thanks, Walt. Appreciate it. My background is after business school, I worked at Oracle Corporation doing a variety of things for them, and have been on the buy side since 2001. I think my kind of core skill set is I'm very focused on kind of understanding software, understanding developers. I also spend a lot of time, anyone who's met me will know I constantly ask questions like, what did you do this morning with respect to your devices, et cetera, et cetera. I'm very much consumer focused as well, which results in a lot of internet ideas. I think it's worth noting, there are four of us on the team. We all have different domain expertise, but we kind of have challenge response methodology with respect to kind of getting a position into the portfolio. And because of the diverse backgrounds of the team, you really need to convince one, if not two, of your teammates why your idea is warranted and why we should invest in a company. So I often say individual responsibility with kind of a Socratic method with respect to getting into the portfolio. The net result is, with the various backgrounds, three of the four people being engineers, myself not an engineer, we really kind of pride ourselves on good risk-reward decision making.
Yeah, and as you can see at the bottom, we also have Gunnar Miller, who's a longtime sell-side analyst who now runs our research platform in Europe and is the head of global research. And he's He's on a call with us every Thursday, so we get updated on the companies that he's visited and met with. So I think, as Mike said, it's a very collaborative process. Our philosophy is that we believe that technology is more of a winner's game. We look for companies that are winning, and what that means is that we're constantly looking for these new sub-segments of technology that have new ways of doing things or much lower cost ways of doing things that bring benefits to users that are not just transitory but last 5 or 10 years. And what we try to do is find the leader of that industry subsegment, because the leader in technology, whether it's consumer or enterprise technology, tends to gain share over time. And it's much easier to manage a company that's gaining share and leading the category than it is to be the number 2 or number 3 company. And so we build a portfolio of these leaders in these different subsegments of technology. And we think that diversification is important. We don't want to have 15 or 20 of our portfolio in a mega cap stock simply because it's 15 to 20% of an index. So we want diversification in the portfolio. And then we spend a lot of time not just listening to management, but also going out into the marketplace through our grassroots research capability, which is a separate group that does surveys of customers or surveys of suppliers and users of technology. And this is a worldwide organization that's proprietary to us. The other point I would make about technology is, now that it's 25 to 30% of most indices around the world, that it's very much a mature industry, and there are only about 20% of the companies in technology that are growing over 20% a year. So most of the companies are mature, and that doesn't mean that you can't make a lot of money in those stocks. And I think that particularly in this year, you're seeing a recovery in the economy, and you're seeing a lot of stocks in this value category, as we would call it, that are going to have explosive earnings and could have very high returns for investors. And so that's an area that we've increased as a percentage of the portfolio over time. It used to be about 5 to 10% of the portfolio. Now it's 20 to 30% of the portfolio. Again, it's a mosaic as to how we develop our ideas and develop our portfolio. As Mike has said, we spend a lot of time talking among each other about different ideas and meeting with suppliers, customers, as well as the managements. I think our geographical location historically has given us a big advantage, because many of the companies are down the street or within an hour's drive of our offices. And so we spend a lot of time not just with the CFO of the company or the IR, but also meeting other managers in the company that are made available to us over time. This basically covers what I just talked about. So I'm going to talk about the portfolio composition. And we think about the portfolio in 3 categories. I would say traditionally we've had a very large percentage of our portfolio in these high growth, innovative companies. And our bias is to look for these high growth companies. And when I'm talking about high growth, I'm talking about companies that are growing secularly over 30% a year. Then most of the large cap technology companies fit into this GARP category, as well as other mature companies. They're growing their earnings 15% or more, and they're reasonably valued. And reasonably valued to us means a PEG ratio of 1 to 2 times, depending on the cycle that we're in valuation. And then I talked about this this value part of our portfolio, which has gotten to be a larger part in this environment that we're in 2021. Valuation of technology has been pretty close to the market until recently, and what happened in 2020 is that the new models that have been developed around subscription and around subscription and additional stability, more services, more maintenance coming from companies has meant that in 2020, technology was very resilient in a difficult economy for most companies. And I think that resilience has been rewarded with a premium in valuation that's started to emerge in technology. And we think that's justified, that many of these companies were actually able to grow just as fast as they forecasted after missing their forecasts in the second quarter, because technology was so critical to dealing with this change in circumstances. And companies that had moved to the cloud and moved to a more modern architecture actually were able to adapt their workforce to the pandemic and work from home and have secure installations. And those that hadn't adopted technology or were still on traditional infrastructure, they struggled. And so as we enter 21, the companies that were struggling are saying, well, we're now determined to move to a much more flexible architecture. And so we're actually seeing pipelines build and order rates improve for many technology companies. So there's a recovery in orders, but I think the fact that they made it through 2020 was why this valuation is increasing. And I think even in some of the value sectors of technology, valuation is increasing because you have fewer and fewer companies that are able to keep up with the pace of technology and the investment associated with technology. So, for example, in the semiconductor industry, you've had this reduction in number of companies that are making memory chips, for example, and fewer companies are able to afford the next $5 or $10 billion plant, and therefore the ones that are left want a higher return on sales so they can maintain a comparable return on capital as the plants become twice or four times as expensive. So I think the profitability, the higher free cash flow associated with the industry is being reflected in valuation. Now there's a movement to the cloud, and Mike, you want to talk about this?
Yeah, I mean, so first of all, thanks, Walt. The one other thing I'd add about 2020 is I think it was really a demonstrative year with respect to showing the pervasiveness of technology as to how it could be a key enabler for so many businesses. And it wasn't that it wasn't the same in 2019. It just was in our face in 2020, as those of us on this call saw that getting takeout became a very big challenge. And for many companies, in that example, technology was a key enabler. So we've had this kind of thesis that technology is becoming more pervasive throughout industry, and it really came to fruition in 2020. With respect to just thinking about the cloud and software, I mean, the way I've thought about it simplistically is almost every business process that companies kind of have are being replaced with some type of software service. I mean, it really runs the gamut between, whether it's looking at, actuarial risk for insurance companies through kind of, facilitating, a customer interaction around buying Nike shoes. So you have this situation where companies are basically saying to themselves, we have this legacy infrastructure and we need to change our business processes. And the way we change our processes is by looking at software Because if you don't have software, you can do it with people, which is what they, if you go back and look at old photos of, the GM accounting department in the 20s, you just saw hundreds and hundreds of people, entering things into general ledgers. That's just been replaced with software. And, I really don't think that I'm always fascinated when I read a daily email that talks about companies got funded. It just amazes me that, literally, these kind of smart entrepreneurs are going through almost every business process in out there and thinking, can we do this with software, and can we do it cheaper, and can we give our customers more benefit? And those are kind of the three things you need to do to have software sell. So, I mean, this just demonstrates the secular tailwinds remain really strong and will continue to remain strong as people kind of, re-platform.
I think the point of this graph is that even though we've been talking about the cloud for 7 or 8 years, that large enterprises are only now moving their legacy infrastructure to the cloud. Maybe they're buying sessions from Amazon to do development and test, and that is migrated to the cloud. But the core infrastructure of the world is now migrating, and that migration is in process, and it's going to continue for the next 10 years. And the companies that make the stack for the next 20 or 30 years of enterprise infrastructure are going to be great annuities. They're going to be embedded in this new company infrastructure for the world for a long time, and if they're doing it successfully for their customers, if they have happy customers, they're going to continue to maintain those relationships and add to those relationships. So, the first stage is moving a lot of your applications to the cloud and your data to the cloud. Then the next phase, which some people are calling, software as a service 2.0, is to add intelligence into your process. So, using a Salesforce example, the first stage was to move your Salesforce management system, your CRM system, into the cloud. Then the second phase is to apply AI to all of the information that you have about your customers and your customers' interactions, the installations that they have of software, their budget, and that can be gleaned not only from Salesforce conversations, but if they call in for help, that provides information. Information about the company's prospects can be gleaned from news reports, and all of this can be put into a model so that when the salesman opens up his Salesforce application in the morning, he's got a to-do list that's probability weighted of how he should spend his time, and that makes him much more productive, and it makes the customer much more satisfied because he doesn't have a salesman calling him when he has no budget and annoying him, but he has a salesman calling him right when he needs needs to get the new application or his problem solved. And so I think that this area of smart applications is just starting, and it's going to be very powerful for the next 10 years. Willie talked about performance. I think our performance has been good, and we aspire to grow our portfolio, our returns 15 to 20% a year, and I think over a long period of time we've done that. So hopefully we can keep that going. I'm not going to talk that much about last year, but last year was a year when a number of special companies emerged, and companies like Tesla, Zoom Video. I think you're all familiar with those companies. Zscaler and CrowdStrike were security companies. As people move to the cloud, they need a whole new wave of security protection. both on the endpoint, because now they're working on a computer that might be their home computer that could be compromised, or even their work computer at home could be compromised through some sort of malware that is downloaded on that machine. And so you need a new way of accessing cloud applications and work applications through the internet. And that's what Zscaler and CrowdStrike basically protect. Square is a company that during the pandemic, the government distributed money to less fortunate people, and Square was involved in that program, and it dramatically increased the number of users. So they've been growing their users about 5 million users, 5 to 10 million users a year in their Square application, their consumer application for sending money to other people and using it with merchants as a debit card. But the pandemic basically caused their user base to grow from 15 to 20 million to 30 to 40 million. And we think that those new customers are going to continue to be monetized by Square. And then MongoDB is an example of a company that is replacing the traditional relational database with a document database, which is much more relevant when you're trying to entice customers into your products, or you're updating your catalogs or your manuals over the internet. So they're a very fast-growing company. If you look at our positioning today, this is as of the end of January, you can see that we're not adverse to large mega companies like Alphabet and Amazon, Microsoft and Apple. We own all 4 of those companies in our top 10. But we also have companies that we think are more mid-cap, and these companies we think can grow very dramatically. And I would say there are a couple different categories here. The Micron and Samsung kind of play into this theory that we have that return on sales is secularly increasing for the survivors of the winnowing out of the memory companies, the few companies that can stay up with the technology pace, make the investments in the new technology, and provide memory to customers and new processes to customers. I've talked about CrowdStrike and Zscaler. You want to talk about Paycom and Twilio, Mike?
I'll do Paycom and Twilio. I think we already hit Zscaler, but I can hit that as well. So Paycom is a company located in, of all places, Oklahoma City, which I've now visited a few times. And they're a next generation payroll company. So what they realized were the traditional payroll companies weren't really, they were charging kind of high fees for a service that was kind of subpar. And Paycom came up with a software solution for payroll, but they didn't really stop there. What they basically realized was the more kind of you can empower your employees to basically, whatever, Mike Seidenberg needs vacation this week, so I put it in my own vacation. I had a change in health status, et cetera, et cetera. So they've really taken payroll and they've expanded it out into a much bigger kind of employee-centric application. And what they found with their companies is they've not only been able to increase employee satisfaction for companies that use their solution, they've been able to take out costs. And the net result is they built this just, this really amazing business. Now, I will tell you, 2020 was a tough year for Paycom. It's been a tough stock. It was an underperformer. I've spent many kind of nights kind of pulling my hair about it, but I think that in 2021 and 2022, it's a good recovery play. And I just feel like their ability to distance themselves from the competition just continues to kind of permeate, continues to increase. So that's Paycom. And with respect to Twilio, Twilio is the best way to think about Twilio, in my opinion, is to think of it as it's a key, it's a software enabler. So what Twilio allows companies to do is if I want to message Walter Price, I could use the Twilio widget, for lack of a better word, in my application, and it'll message to Walter and over any modality. So you say to yourself, that seems pretty trivial, but it's actually a very difficult problem to solve. And yeah, companies that try to do it themselves really run into lots of issues. They've just seen explosive growth over the last 12 months. They'd seen really strong growth in the previous 24, and we've owned the stock for multiple years. But the last 12 months, they've kind of been brought into things like e-health during the pandemic. They've been brought into, call it, COVID notification, et cetera, et cetera. So every time, everybody on this call, every time you get asked about your password and you type it in and then they text you a code, that's usually Twilio that's texting you the code, but they just do a lot more. And now they're taking that core solution and they're building an application on top of it for call centers. So they're going to relook at the entire call center market and say, shouldn't it be more remote, flexible, and easier to do business with? And the answer to all those questions is yes. And they're going to, facilitate it remotely, which is a huge opportunity as opposed to having, post-COVID, having, thousands of people in a bullpen. So it's a really exciting company. I'm sorry if I droned on too long about it.
Thank you, Mike. Just understanding how the portfolio is positioned, again, lesser weighted in mega cap. Mega cap is 58% of the index. And you can see number of holdings. We typically run, I would say 60 to 80 holdings, and we're in that zone at this time. Weighted average market cap or median market cap is much less than the benchmark. And what we're focused on for this year is earnings growth. So, obviously valuations for the whole market have gone up, and we think that companies that have high earnings growth can grow into those valuations much faster and more easily. So if you look at the earnings growth of our portfolio for 2021, it's 43% versus the benchmark at 17. So we have much higher earnings growth in 2021 and a much higher secular earnings growth. And we have a higher PE that we're paying for that earnings growth. But if you look at our PEG ratio, it's actually less than the market. So you're paying a higher multiple, but you're getting much higher earnings growth. And I should add that the earnings growth for many of these companies is just getting started. Many of the SaaS companies, we've seen with the large SaaS companies like CRM and ServiceNow that they lose money or barely make money during their initial phases because their sales cost is so high because they're basically selling subscriptions and only realizing a month's worth of revenue, but the salesman gets the contract, the sales commission for the contract when they sign it, and it's typically 1 to 3 year contract. So, but as the customer continues to grow and renews that contract at a lower commission level and with less sales effort, you see the companies become dramatically more profitable as they mature. And so, we've seen that process. That you have proof points with companies like Viva and ServiceNow, and to some extent CRM, of profitability really exploding as the companies lap the hyper growth and go into more sustainable growth rates of 30 or 40%. And I think that the point of that is that earnings growth for many of the companies that we own that are in this emerging state are going to be quite explosive as we go out to 2022 and 2023. So we think growth rate of earnings is going to continue to be quite robust even after the recovery matures. And then these are some of the themes that we're focused on in the portfolio today. I think collaboration and work from anywhere is here to stay, and companies have found that their sales processes are more efficient, that their development effort is still very efficient. And so, I think that companies are going to double down on this collaboration and work from anywhere effort. And we think that's wonderful for a number of the companies in our portfolio. Mike, you want to talk about advertising?
Yeah, sure. We continue to, I think, here again, those of you who've met with us before, I think we were very early kind of understanding the power of a product like Instagram and Facebook. So I think that, conversely, as those companies have matured, we're looking at other advertising-based models, whether it's a company like Snapchat, where we think that the demographic is very appealing, or a company like Pinterest, which we find, has really kind of come into its own during the pandemic. Look, I think the biggest risk to advertising models this year is just kind of how things how does Apple impact that ecosystem? In general, the worry tends to be worse than the bite. But having said that, you're seeing companies like a Facebook really kind of, struggle to kind of keep up with the index, because of both regulatory as well as some of the Apple changes. But we still kind of look at, at kind of next generation advertising systems and next generation payment systems as just a really robust place to be. And there's really interesting stuff happening there. So it's not just advertising. Sorry, I was talking about advertising, but also just thinking about payment systems. And, a company like Square falls into that. But, for us, there's still just a lot of opportunity to kind of displace the traditional credit card, the credit card swipe. And you're seeing it. You're seeing, people kind of use their own personal credit to with these companies where you buy it and you basically pay for it over time without an interest, without an interest charge. That's starting to take traction. So there's a lot of stuff happening there. We'll step wisely with respect to making sure that, we'll only invest in the models that we really believe in. But that's an exciting space.
We also talk about automation and increased manufacturing. I think one of the aspects of manufacturing that we've observed is that the default for your next plant historically for the last decade has been China, and that's changed. And so companies are much more concerned about flexibility in their supply chains and having a supply chain that's closer to their customer. And so I think that's causing manufacturing plants to be built and updated to allow that flexibility. And the plants that are being built are not the plants with a million workers in them. They're much more focused on robotics and automation and vision systems to reduce the number of people and make the people that are there much more productive. Electric vehicles, we think, is a wonderful theme for the next 5 years. I would comment that we made a lot of money in Tesla over the last couple of years. That we've reduced that as a portion of our portfolio because we think there's much more value in the component suppliers to this industry as you have 100 new electrical vehicles introduced over the next 2 years. And so we think there are not 100 new semiconductor companies that are selling the IGBTs or the silicon carbide products that these vehicles are using to extend their range and improve their performance. There are very few companies. And so we think the profitability of those companies is going to improve. It is improving, and the growth rate is going to be quite high. And that would apply to battery manufacturers as well. There's a shortage of battery manufacturers and capacity to manufacture batteries, and therefore the profitability of those companies, which had been quite low a few years ago, is starting to improve. And then suppliers to leading cloud infrastructure companies. You know, we have a theme that some of the less popular areas in technology, such as disk drives, have gone through this same transition that users have gone through in moving to the cloud. Their customers and enterprise have atrophied, and they've, you know, many of the hard drives that we're selling to PCs are now not, you know, have been replaced by SSDs, electronic drives. And therefore, they've gone through this huge transition over the last 3 years where the business to the cloud has gone up dramatically and is growing dramatically, whereas the business to enterprise has gone down. And so we're crossing that transition point, and we think that these companies that supply the cloud infrastructure companies are actually going to see a good solid growth, just as the cloud companies are growing at 30 to 40% a year over the next 5 years. So, you know, I think there are lots of opportunities in technology. We see this as a period of rapid change, lots of acceptance and use of technology. And I think it's a wonderful period to be a technology investor. And we think that technology can continue to provide superior returns and should be part of any growth investor's portfolio. So I think I'll stop there and see if there are any questions.
Thanks very much, Walter and Mike. So there's lots of questions here, but well, okay, PE ratios look pretty high, I suppose, in absolute terms. What do you think would be a respectable pullback to make a more attractive entry point?
Well, I think it depends on the sector and technology. I think in the case of the high growth companies, their multiples and their stocks vastly exceeded their earnings growth last year and their revenue growth. And I think as interest rates normalize, they're going to have to grow into those valuations. So, you know, I'm not sure whether the stocks pull back, you know, by 5 or 10%, or whether the companies simply plateau in their stock price while their earnings grow into the valuation. But our methodology is that when stocks exceed our price target, we reduce our position, and we've been, you know, if you look at our position last year in the cloud and in these high growth companies, it was 45% of the portfolio, and today it's you know, probably half that. And that money has gone into the you know, the semiconductor industry and the hardware industry, where we think valuations are still quite reasonable. The stocks are starting to come out of their COVID depression in terms of earnings and demand, and we think earnings are going to be really exciting, and valuations based on our estimates of earnings for the next 2 years look quite reasonable, less than the market. Mike, do you want to expand anything on that?
Yeah, I would just say that, you know, within the software or within, we tend to kind of step wisely is the way I describe. So, you know, a lot of the names that benefited last year are names we've owned for multiple years, and you know, we will trim accordingly on valuation. But you know, I'll take it. You know, I'll give you an example with a company like Twilio. I mean, we still think that there's a great secular outlook for the business. So, you know, we will find opportunities to trim and add to it, but you know, I don't foresee us selling that stock. And I think that one of the hallmarks of our fund has been the ability to kind of find secular ideas and to really understand a multi-year risk reward thesis around that. You know, what I worry about is lower quality companies, and that tends to be something we don't invest in. But you know, as the market, you know, kind of pulls in, it'll take everyone down with it. But over time, you know, the leaders will reemerge, and we've just seen that in our career. So you know, here again, being bottoms up stock pickers, I think that, when we find a sector and a company in that sector that we really believe in, we'll look at the risk reward, but, we're probably not going to sell it just because it's expensive.
So a related question on the, it's leading the question, but on quality, but there's obviously a tsunami of IPOs and SPACs coming to the market. You don't invest in private companies, so it's just listed companies that you invest in. So how do you digest all these different opportunities and decide whether to take positions in them?
Yeah, I can take that. I mean, unfortunately, in this past kind of, call it 5 to 10 year cycle, a lot of the value creation that used to be afforded to public market shareholders has actually gone on the private side. So you get companies going public at, really kind of obscene valuations. And what we do is we do the work on the names, and when it gets to a valuation where we can get the risk reward to work, we would buy it. For example, like I think that Walter and I would tell you, we really like the Airbnb business. We think it's a great business. We think it's a strong brand. We think it's a future. We'll have to find a spot that makes sense for us to kind of make it a position of any material size. And that wasn't the first day it went public. In that scenario. So, we've been frustrated with some of the great companies and their, and their valuations when they come public. Having said that, we usually get our shot to own these great businesses. You just have to be patient. With respect to SPACs, they're just kind of head scratching for us in that, you see them kind of appreciate on basically rumor, without any kind of tangible business. And some of them just the speculation that they're going to buy something. That's just not what we do. It's, we tend to, at the end of the day, I want to work really hard for everybody on this call and invest in, tangible businesses. So we haven't played in the SPAC market. I guess it's something we could look at, but we don't feel like we have any advantage there. Whereas I feel like I have a competitive advantage when I go meet with a company, because I think many times, because of our process, we understand that business quite well, and we can understand it better than Wall Street. I don't have any advantage, I feel, in the SPAC, at least today. I don't know if you want to add to that, Walt.
I look at the SPACs as really venture capital. They're really providing a cheaper form of capital to many of these venture firms that would be traditionally funded by VCs, and they're now funded by the public markets. And the failure ratio of venture capital is 1 out of 10 companies are successful. So we're looking for those companies, and we've met with many of these SPAC companies recently to try to figure out, that many of them have very impressive management teams. We want to see them execute with products and customers. As Mike said, that when we can start to talk to customers and see the products, then we're much more interested in investing in the company.
Great. Just a couple of very specific ones. We've got a couple of minutes left, but only a small sliver in China. Why is that? And also quite a large cash position. Is that usual, or is that just a timing thing at the end of the month?
On the cash thing, it's anticipating a correction in the market. So this tactical thing that we do with our portfolio is the result of trimming some of the high valuation companies and waiting for an opportunity to either add to the ones that we like. So we basically winnowed down the list of high growth companies into the ones that we really like, and we would like to add to those on any sort of pullback. And in addition, we've been putting more money and doing more work on some of the value companies and as we get confidence in those companies, we've taken positions and started to take the cash position down. So it's come down since the end of January.
And then China?
China, I think Wachen a couple of years ago got worried about the regime in China. He's from China, and we've been investing in China since 2002. So at one point it got to be close to 15% of our portfolio. I think right now we feel that the environment for entrepreneurs in China, particularly among the larger companies, is a difficult one, and it's also difficult to get money out of China. So even though you say, well, this stock has got a reasonable valuation, if you're a Google or a Facebook or an Apple, you can buy $1 billion of your stock, no problem. I think it's more difficult for the Chinese companies to get that money back to their investors that are not in China. So those are two reasons that we've taken our position down there.
Fantastic. There's a lot more questions there, which I'm really sorry we haven't been able to get around to, but it's now time's up. But Walt and Mike, fascinating as ever. Thank you so much for your time, and thank you all for listening as well. Our next session, starting at 4 o'clock, is the manager of Edinburgh Worldwide, Douglas Brody. So tune in for that if you'd like to. Thank you so much.
We want to thank our investors. We really appreciate them, over the years supporting the fund. So thanks to everybody on the call who's believed in us and continues to believe in us. And we're working hard every day for you.
Thanks, Mike. Okay. Thanks, guys.
Bye.
Thank you.